Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In today's episode, we have the honor of hosting an industry titan, Shundrawn Thomas. With over 25 years of impactful leadership in financial services, he brings a wealth of knowledge and perspective to this fascinating conversation. A Southside Chicago native, Shundrawn's life experiences have colored his views on everything from societal economics to the critical role of education and faith. He particularly shines in his ability to marry investment performance with positive societal change. As the founder and managing partner of the Copia Group, he's breaking down barriers by providing economic opportunities and access to capital for underrepresented entrepreneurs. This discussion dives deep into the importance of diversity in business, the hurdles in securing capital, and the transformative work Shundrawn is spearheading. Listen in.
Shundrawn Thomas, welcome to Educational Alpha.
Bill, pleasure to be here with you.
You've been a stalwart at the Alt series, which I think we'll cover. And right before we came on, we were talking about, I think the last time we were together was the closing act, Alt Chicago. And I thought it was a powerful conversation. I learned a lot. And I think you kept a fair number of people in their seats. So it's important to know that your message is meaningful and impactful, which is the mission of the business we're all in, and maybe you more specifically. But before we get into that, I think a lot of folks know you, some don't. So maybe a little bit of your background and perspective as we begin the conversation.
Sure. Well, Bill, I guess I have to start. I am born and raised on the south side of Chicago. One of those curious Southsiders, if you're from Chicago, that's actually a Cubs fan, but that's a longer discussion. And I was one of four. In my household, kind of grew up a little bit as the oldest, given the spread between myself and my older brother. And I was the son of Air Force veteran and steelworker. For me, a lot of the formative experience of my life happened in those adolescent years. I was a product of the 70s. Unfortunately, you can recall, Bill, the history of the steel mills closing. My dad was affected by that. And that created, frankly, a lot of economic hardship for the family. One of the things I looked to in that period of time, though, so much I learned from my father, his attitude, his dignity, and whatever kind of work he needed to do to take care of his family. But also, he was a person, my parents very strong in their faith, and that was a foundation. Education was a springboard for me. So I did my undergrad at Florida A&M in business, ultimately did my MBA in the University of Chicago. But through my interest in business, ultimately found my way to the world of finance, working for Morgan Stanley, Goldman Sachs, and as you know, for an extended period of time, 18 years at Northern Trust. And so that's professionally. I'm blessed to have a wonderful wife, better than I deserve, 26 years, Bill, and two college-age sons. And I love the business of investing. I love the season of my life that I'm in now as an entrepreneur, being able to build a business, both focused on great investment returns, but having a meaningful societal impact.
Great summary. And maybe just one thought before we get into what you're doing now. You mentioned your dad's service, and I'm one of seven, grew up in a very solid middle-class area of Yonkers. And my dad served in the Korean War, so service, maybe not to the same degree as your dad, but also religion and faith were a big part of growing up. I'm a severely lapsed Catholic, not necessarily proud of that fact, but I look at the many challenges in society today, and I think about maybe some of the commonalities of your upbringing and mine and many of our generation, where faith and religion and service meant something. They're part of the fabric that kind of held a community together. And we're seeing less and less of that. And I don't know how we fix that if we just turn a page to a new chapter. But I think of the many issues that I see, and I've got my last just started college this week, the level of mental illness on the college campus, it's just off the charts. And I just wonder if we're raising a generation of people that don't have enough perspective and optimism and things to latch onto. So I don't want to turn this into a philosophical discussion. It was interesting when I heard you mention that. I couldn't help but at least swing at the fat pitch.
I'll observe a couple of things. I think that if you think about similarities in how we grew up, I think there's a lot to be said that there was a sense of belonging to a broader community and a responsibility that you had, not to just your family, and families were strong units, but to your community, and that extended. I think there was a deep respect and a profound respect that we had for people who did things like serve in our military. And I think there was a reverence and respect for people's commitments to their faith, whatever your faith may be. And I do see that as we've seen, in a sense, significant areas of financial success, and then the focus on that sort of individual quality that is prized in Western culture broadly, but certainly in the US, I do think that we've seen a depreciation in that, Bill. And I think the reason that is relevant is because, one, if you're going to achieve anything significant, you don't do it by yourself. And quite frankly, the strength that we draw on when we go through tough times, I know for you and for I, it was the same. It came from your community, it came from your faith. And so I think that there is something lost when we don't give requisite appreciation for those things. And I think that we need to think about that in the way that we engage one another, in the way that we raise our children, and the way that we have civil discourse in society.
I think we will just park it there because we're not going to solve it. But I think those two words, civil discourse, is important, that you don't have to agree with the person on the other side of an issue, but oftentimes trying to find compromise and a way forward is critically important. Maybe moving on to the Copia Group. And you are like a complex onion, Shundrawn, because every time we talk, or I did a little bit of research in advance of this, I peel back another layer and I learned something new. And I think I already know the answer to this about why the Copia Group, why now. And then it reminded me, I knew you had written a book, but the title of the book, I think, is the answer: Discovering Joy in Work, Transforming Your Occupation into Your Vocation. And I certainly found that at Kaya. And I think that perhaps I had it to some degree in my prior lives, much more capital intensive. And you probably had that at Northern. But maybe talk about, well, maybe that is the reason. And maybe to make it a little bit more of a complex question, this current generation is so focused on work-life balance. And I say to them, if you want to have that balance in your 20s, go ahead and do it. Just sit on the couch, get a job, don't form a career. But then you're going to wake up in your 50s and 60s and realize that it's not the balance you were hoping to have in the first place. So you got to invest it in the first place. And I've spent a good part of my early career doing things I liked, but not necessarily loved, which has allowed me now to live the very title of the book you wrote. So I don't know if that is a requiem to what Shundrawn has done, but curious to hear why your thoughts of the Copia Group and what you're looking to accomplish there.
So I'll start with the first part of your question because it does tie to the book, because the book reflects some of the truths of what I've learned and experienced in my own life. And I know you can appreciate this, Bill. I was able to get involved in management relatively early, and you get this tremendous responsibility of leading people. And so you spend more and more time mentoring, supporting, and sponsoring people. But I was surprised to find how many truly talented people, when you really pressed them and they told you their truth, were very despondent or very dissatisfied with their jobs or their work. And it got me to thinking about my own experience. So the short answer is, people say this work-life balance. I always tell people, I don't believe there's any such thing. What I do believe in, and I talk about this in the book, is what I refer to as work-life synergy. And so I think I only have one life. And I think that my vocational journey, or whatever I do and I choose to do as a profession, has to fit in that context. And I need to be able to find work that I can do in a way that ties into the things that are important to me in life, the things that I value. I'm not one of these people that believes that there's some mythical perfect job for an individual. I think we find joy in whatever work that we choose, but I think that has to come from the inside and not the outside. The last thing I would say, when you think specifically of the Copia Group, it becomes the next leg of a journey and a culmination of many things for me. But it's me finding a way to take the deep expertise and relationships that I've developed over time to pursue this great field of investing, but do it in a way that fits with my values, Bill. And my values say to me that it has to be more than just making financial returns, that if we're going to spend most of our waking hours doing anything, there should be some positive benefit to the people that we care about, the communities that we connected to. And we do that in a specific way at the Copia Group. And in particular, we're looking to provide more economic inclusion, more access to capital to great firms across the spectrum, but especially in including ethnically diverse and women-owned firms.
I know you've been very vocal, and maybe you can share some of the stats about the inequities, about access to capital, because therein, I think, lies both a bit of the problem, a bit of the opportunity, and maybe a bit of a thesis for what the Copia Group is trying to do.
So one of the things is I start with this observation of what's one of the things that makes this wonderful experience or experiment we call the United States so great. And I think there are two things I would argue that are central to that. The tremendous diversity that we have. We are truly a nation of immigrants, all these different perspectives and nationalities and ethnicities. And then it's the entrepreneurship. And so when I think about then tying that to the question that you asked, there's this disconnect, because if you look at what we consider to be traditional minorities in this country, and if you look at women, what's ironic is women start businesses now today at twice the rate of men, Bill. And in ethnic minorities, the number is probably about 60% the rate of their majority counterparts. I mean, just take it as a fact, not bad or good. But when you have that level of entrepreneurship, and then when you think on the other side of that, those demographic groups would make up well over 70% of the population and growing. But when we look at private capital, they capture about less than 4% of private capital. There has to be some kind of disconnect there. And the thing that is really interesting to me is when you see studies increasingly that come out, it's not about the benefit that creating more economic inclusion and access to capital would have for those groups. I would argue we should do it just for that alone. But what we see is economically the pie grows so that we would all benefit by better employing this entrepreneurship and these talented resources. And that's what I think about. And that's why the name Copia, which is a Latin word that means abundance or plenty. Because our view is there are these tremendous untapped resources that if we can invest in the right way and we can support and grow, it benefits not these singular communities, but all communities, Bill.
Remind me, how long ago did you start the Copia Group? Was it within the last 2 years?
Yeah, so we launched the Copia Group formally going into the fourth quarter of 2022. Now, I transitioned from Northern Trust June 1 last year. There was an announcement that went out of Northern Trust May as I was leading into my transition directionally what I would be doing. But we are really formally launched in the last year.
And I want to get into some of the details of what you've accomplished and looking to accomplish. But as you look back in those 2 years and as an investor, it's hardly the long term, but any observations on maybe your biggest surprise and biggest disappointment, the things you expect to happen, but life is funny. You have a plan and then it gets in the way. So maybe your experience is plus or minus.
I expected it directionally to be true, but biggest upside surprise when I look at our investment pipeline, Bill. So if we look at the things in our investment pipeline, one of the things that we were challenged by some asset allocators as we've been in this capital raising process, there are a lot of people that believe as soon as you begin to say gender diversity or ethnic diversity, that means lack of opportunity. And the reality is today we sit with a pipeline of private investments where 75% of the companies that we have in our active pipeline are owned and or led by ethnic minorities and women, and actually specifically ownership at that level. We sit with a pipeline of companies where many of people that are in the private credit space where we're focused, a lot of their opportunities come solely from equity sponsors, but nearly 80% of what we have in our pipeline are opportunities we've been able to independently source through our relationships and people's belief in the vision that we have. So I would say we expected that to be positive, but that's been to the upside. What did I expect? And you know how sometimes you have expectations and they're even tougher than you think. It's interesting how things have played out in the fundraising environment. Now, we are actually having some success. We are moving through a first close. And I mean, we're fighting tooth and nail, but I'm pleased at early commitments we've gotten alike. But I want to give this comment on the broader financing market because it's very concerning to me. If you look over the last 12 to 18 months, the fundraising environment has tightened for everyone. But if you look at diverse-owned firms, Bill, I think through the first trimester of this year, we've only seen a little over 2 billion. So it's about 2.3 billion in capital go to about 56 firms. I want to put that in context. The high water mark we would have seen is the full year of 2021. That number would have been through a full year of 57 billion to well over 700 firms. If we continue on this pace, we'll see one of the lowest numbers that we've seen, certainly in the last decade. You have to go back to about 2013, even before that, depending on the track that we're on. So what it means is while we're seeing more diverse talent, more entrepreneurship with diverse companies, if you look at diverse-owned GPs or managers in the space, they're getting precious little capital. And that's against a backdrop where when you look at the actual performance of these firms, Bill, like if you were to go to the NAIC's website and look at some of the performance results, we see a consistent pattern of the results actually showing outperformance. That's been one of the things when I look at the environment that's disappointing, because I take away from that, we're not optimizing our talent and our opportunity set.
I think tied into that, Shundrawn, I don't know if you said this to me when we were together in Chicago, I read it somewhere, but I think you used the phrase flight to familiar. And I think when capital is tight right now, full stop. And I think the safety net is to go to what you know. And perversely, that might be a pure beta play as opposed to the alpha, because the alpha is bound to pockets of great inefficiency. So these cycles are cyclical, but is that a bit of a headwind for your business model today?
Yeah. So what concerns me is I think it's a headwind on some level for any business that wants to take advantage of investing in these more underserved markets. I remain optimistic. What I get concerned about, though, is over the arc of time, they become self-fulfilling processes. So for instance, I'll give you an interesting stat when you think about investing in private companies. So a lot of times people will say, well, we don't see the same level of scaling in diverse-owned businesses. And I said, but we create those outcomes. So Bill, a true fact, if you had 3 businesses, they literally were the exact same industry, same credit statistics. Here's what the Federal Reserve research will show you. If the business happens to be a white-owned business, 56% of the time, they will get the entire ask that they have from a lending standpoint from their bank. That number reduces to 32% if you're Latinx or Hispanic, and it goes down to 26% if you're African American. So what that means is you can have literally the exact same business, and one of the reasons they won't be able to scale in the same way because we're literally starving for capital. And so when we talk, whether it's fundraising, whether it's access to capital and all these things, we are not looking at the fact that we are ourselves, by virtue of our decisions of inclusion or exclusion, creating many of these outcomes.
Just as a very quick aside, and I don't think we want or need to get into regulation, but as you probably saw, the SEC had this very aggressive private market regulation out there, and the lobbyist group beat Gensler and co. back, and he took a lot of the toothiness out of this regulation, which, I think if you have a regulation that's focusing on greater transparency, a fiduciary standard where you're putting the interest of the investor first, it's important. But I was supposed to speak to a reporter Wednesday from Montreal, but then the ruling came out and she was scurrying, so we never spoke. So I did a little bit of research, so I was prepared to have some thoughts on this beyond what I knew. If I read some articles on it, I looked at some of the comment letters written, and some of the comments I saw were, if they go through this, it's going to stifle innovation, discourage investments in innovation, but then hurt the minority and women-owned firms out there, which that struck me as a little bit rich in that now all of a sudden they're using that as a bit of a plug to say, don't do this, when the numbers are showing that, yes, it's true, but it's true on such a small margin. And the fact that it didn't go through is going to help. I don't know, but can just leave that aside. I thought it was kind of interesting to see that. So I just want to, as an intro to the 4 C's, one of the C's is counsel. And you mentioned about the companies in your pipeline, and I assume you must have some underwriting standards. And there's some companies that are probably either a little bit too small, they don't have the right structure, they don't have the right operations. Do you try to, and I know you have limited resources, but for the ones that don't quite get onto that list of opportunities, is there anything you can do to help them get to that next level. So in fund 2 or 3, they can become an opportunity set for you and hopefully for themselves.
So it's funny that you asked that because it extends a differentiation that we have. So first of all, just you referenced it, this 4C approach, we talk about what we describe as the essentials that companies need to scale capital. And that's not just the financial capital, it's social capital, it's the right kind of structuring of the access to that capital. We talk about the counsel, the advice, we talk about the colleagues. How can you find those expert resources or leaders that you need to scale the business, and then find the clients. And so we built our team, our advisory board, and our approach to be able to add value to the companies there. So we want to be more than just a financial sponsor. But to your point, Bill, that extends beyond just the companies that we ultimately choose to take through the pipeline and make a commitment to investing in. Because our view is we're playing the long game. And so I guarantee you, if you were to call up, say, a company that we've engaged with and say, for instance, they didn't meet the minimum requirements today of what we were looking at or what we need to cover from a credit worthiness standpoint or what have you, they would tell you that they had a positive experience with us because we'll take the time to say, here are the things that you need to think about. Here's how both debt and equity investors look at the investment. So what things you can focus on to kind of build that stability. Here's ways that if you allow us perspective, we could give you some advice on what we think of your strategy and the scalability of that or those things. And our viewpoint is minimally, we want to be helpful to anyone we engage with, but you never know what that company's going to do or how they are going to evolve. So we don't look at it as just transactional. So that's something that we do try to commit ourselves to, Bill.
Your LPs, are these the typical LPs you would find in a fund? Public pension plans, single family offices? How are you sourcing the capital?
So it's interesting because I would say over the arc of the entire fundraise, I believe that they will be. So I can tell you with the commitments that we have to date, some of the earlier investors have fallen into a couple of key categories. Interestingly enough, corporations that are thinking differently about both how they invest their balance sheet as well as, say, their pension assets, but corporations. Two, interestingly, probably not surprising, family offices have been an attractive segment because we find that they not only care about, obviously, investment returns, but when we think about impact and inclusion, you find that there's a lot of leadership there. Also, to be quite frank, Bill, the pace of their decision-making processes are often quicker than a lot of the other institutions. Foundations and endowments. We find that because we have a focus both on impact as well as economic inclusion, there's an alignment there. And then just frankly, high net worth individuals. So that's where I would say currently we've seen a lot of engagement from prospective interest in investors. And I would say if you continue and you move out, there's longer dialogues that we're having with typical institutions. Think about the larger foundations and endowments. Think about public pensions, where there's certainly interest in what we do, but you know this business well. Some of those due diligence processes, literally, they're counted not in the days or weeks, but the quarters.
So an interesting lineup of investors. Is the patience of this capital different than I would see in a typical buyout structure in terms of the duration of the hold and the return of the capital? Is it the same or different with, say, raising the capital, investing it for 3 to 5 years, returning it 7 to 10?
Yeah, I think the nature of investing, if you're focused on credit, the duration is pretty well known from the standpoint of a typical credit structure, just in terms of its term, will usually be, say, 5 to 7 years, with the predominance of them in these markets environments being around 5 years. But if you look at then the term being 5 years, the duration of credit structures, if you look back over the last decade, have been closer to 3.5 years because of the incidence of the most likely way that you are paid back when you're making a direct loan is by refinancing. And so I think that you see that typically kind of across the business. And so it's not atypical to see funds that are in the marketplace, if you're talking about a commingled fund, having a term anywhere from, say, 6 to 8 years.
It's all debt. You don't do any equity.
So for us, when we think about the kind of structures that we can provide for investors, we can either have an investment structure where it is, say, a senior loan. We can have an investment structure where it is a second lien, subordinated, Or you can have what we refer to as hybrid structures. So that could be a unitron structure where you have a combination of senior and subordinated debt. You could have an equity enhancement. So you can think of, like, say, for instance, if you had a small portion of preferred stock, warrants, or other enhancements. But we are principally providing debt investments. So said another way, we don't exclusively offer equity. To the extent we have equity in a structure, it is part of a debt financing structure that we put together.
And in terms of where you are in the cycle, have you closed your first fund or are you still raising?
That's an important question that I can answer this way, right? Because again, the thoughtfulness of the rules around this, I would say we are actively in the marketplace, engaging with LPs, and we're in the loan arc of that cycle.
Okay. Before I leave the Copia Group, I want to talk about governance and then the hallmarks of a leader. But before we leave the Copia Group, maybe just to remind the audience of the website, because I think it's a very good model. And I think you could use as many believers as possible, including myself. So if you could just tell the audience how to reach you.
Sure. So we're easy to find if you just go to copiagroupllc.com. Copia, COPIA. So again, one word, Copia Group. LLC.com. We try to make the online destination where it's inviting and it has plenty of good information for people, probably more than typical. So hopefully people will find value in that.
Excellent. And as I said at the top of this discussion, you publish a lot and your LinkedIn profile is rich in content, not just around the Copia Group, but observations and insights. So I would encourage the listeners to follow or connect with you and read what you write there. I think it's excellent. In the remaining minutes, I think we touched upon this briefly in Chicago, I believe, Shundrawn, but if we didn't, that's okay too. The responsibility of the board. And we talk about, leadership starts at the top. And when you hear that, you think about the management team and their responsibilities. But the board has a role too. And I think you probably see, and you can correct me on this, greater diversity on the board than you do in the management team. So I think they can bring very different perspectives, and they're not responsible for managing day-to-day risks, but risk oversight and understanding where the business is going over periods of time. So what is the role of a director on a mutual fund, on a public company, on a private company holding inside of a portfolio of a buyout GP? What is that role, and how important is that role, and how are we doing as a lot there? And if we're not doing well, what should we be doing differently and better?
So let me segregate to two broad categories. I would say corporate boards, and I'm going to put, while there's some differences or nuances, public and private boards in one category, and then I'll come back to fund boards. From a public board standpoint and a private board standpoint, your role is governance. And so ultimately, you're there as a representative of, people will say shareholders. I like to say stakeholders, because there's a broad set of stakeholders. And you have an affirmative responsibility to make sure those stakeholders are represented through your presence and your voice in the room. You have an affirmative responsibility to oversee the management's development and execution of strategy. You have an affirmative responsibility, starting with the decisions that are made, whoever the chief executive officers are, to make sure that the appropriate competent people are in place to execute that. And I think that you serve a combination of both advisor and second set of eyes. We call it sort of nose in, hands out. You've heard the expression, but that's an important role that the board plays. And done well, it means that not only we deliver the best outcomes for all stakeholders, but I argue done well, it's done in an inclusive way. So the fact that we're improving the level of diversity that we see on boards, I think there's research. McKinsey has done it here. People have done it in other places that literally show that more diverse boards, if you look at their underlying companies, that they actually outperform from a stock return or company net income performance standpoint. So I think that's relevant. I think when you look at fund governance for a mutual fund is slightly different. I mean, in the sense, when you think about fund governance, you're not necessarily hiring the executive team of the fund company. You're really overseeing, from a fiduciary standpoint, what's happening with the fund vehicles and fund structures. But let's be clear, you do have the opportunity to engage with the senior investment team, the senior leadership of fund companies. So you do have influence. And I think that influence can be played out in a lot of ways. One of the things that was surprising, and most people don't look at this, is just the lack of diversity among mutual fund directors. If you just look at mutual funds, let alone private fund advisory boards and the like. So I think there's an opportunity there. And I think what that would do, Bill, as you see that increase,
the likelihood that then we go after these underserved and great investment opportunities would increase because of the simple reason, if nothing else, you have more people that are aware of, proximate to, and understand these opportunity sets.
And it is a patchwork quilt, and I think all of the pieces have to kind of be working in unison. And then hopefully one day we look back and we see a work of art up there. But I think something to strive for. So maybe in the remaining minutes, Shundrawn, I think certainly I'm much more the latter fall of my career than you are. But I think about my responsibility around leadership quite often, and not my personal legacy, but the legacy to the industry, and handing off a business or a mission like Kaya to somebody that's going to hopefully continue to build upon it. But I think people, whether we realize it or not, do look up to us, and people that sometimes don't even know us. They may interact with us on social media. So what we say and what we do can be impactful. And I think, again, you may have said this to me. I saw it. I think when you've been asked this question before, humility or be humble is one of the very first things I've heard you say, which I think is a critical attribute to leadership. And you do that so very well. And I even remarked to you at All Chicago, you had the last session on day 2, which started at noontime, and you were there for the whole thing. And you were interacting with the audience. And oftentimes people of your stature who've got a big remit and big level of responsibility say, you know what, I'll show up 20 minutes before I'm on stage. But you made it important to interact with all of the delegates at that event. And that meant a lot to me. It meant a lot to the guests there too. So I think it does speak to your personal brand quite well. But how do you feel about leadership? What are your observations there about what truly makes a good leader?
Yeah, you started with it, and I appreciate that you start there, because the reason I speak about it is not because I go out and declare that I'm a humble person. I think that you can't really do that. You just have to live it, and to the extent it's true, it's something that people recognize. I do think, Bill, though, it is a quality and a characteristic over the 3-decade arc of being in this business I've seen become more and more diminished. People talk about so much being charismatic or your personal brand and all these different things, but that quality, which I think is foundational for all the leaders throughout history that I deeply respect, I think is in less and less supply. And the reason that's important is because when you get to the stage that we're at, I think we have made kind of similar decisions. And that's, for me, even though I believe I have gas left in the tank, I really am thinking about legacy. When I say legacy, from the standpoint, what is it that I can do that has a lifespan beyond me? And one of my favorite, it's an axiom, but it's a passage of scripture, and it talks about that unless a grain or a seed falls to the ground and dies, there is no harvest. What that means to me is at some point we have to move past this self-interest that says it's all about me and how much I make or what my titles are and those things, to say, when I look at the time that I've had vocationally in my career, what's the seed that I've sown in the example of my life that leaves something that others can build on and hopefully take further and do better? And I know that you're doing that in your leadership, and to the best of my ability at this stage of my vocational journey, that's what I'm trying to do. Hopefully, if people can borrow from some of the examples of what we do and take it further and faster, if people can join the culture that we're trying to build and seeing that we're really trying to do something distinctive and they feel they can bring their whole selves to work, if people see what we're doing and are committed to a common mission of getting greater access to capital and more inclusion in our business, if those things are seeds that can germinate into a harvest from some sacrifices that I make in this season of life, I feel like I will have done well.
May that harvest be a copious one. So I just pulled it all together there, Shundrawn. Very much enjoy spending time with you. I thought this was a great 30 minutes, and I thank you again for your ever-present voice and views at the Alt series. I'm sure I'll see you back out there on the circuit someday very soon, as we get into what is going to be a very busy fall season, I think, for all of us as we get through the waning days of August. But Shundrawn, thank you, and great to see you.
Thank you, Bill.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.